Hey guys, thanks for clicking on this video. Today we're going to be looking at GameStop once again, and we're going to be discussing inflation, how we think this will affect the MOAs. But before that, let's have a look at GameStop's price on the day. Started the day at about 157, hit highs of 162.82, then had a lot of selling but has rebounded pretty strongly, so it's now at $161 on the dot. Also, I was told to add a pointer on my video because people were struggling, so there you go. Hopefully this makes it a little bit more clearer. Right, now let's get into the meat of the video, inflation. But before we get on inflation, can you give me a like if you enjoyed the video? It's really helped me out in the last few videos. And if you don't want to give me a like, fine, give me a dislike and just give me some feedback in the comments below. That'll be also appreciated. I want to make these videos as good as possible. So what is inflation? Well, inflation is the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which a decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods. So let's have a look at the key takeaways here, which is pretty important. Most commonly used inflation indexes are the Consumer Price Index, the CPI, and that's what we'll be touching upon today. So on to the next slide on the next web page. This is inflation's impact on stock returns. So if we look at the key takeaways again, it's pretty simple. There's nothing too much here, but it says value stocks perform better in high inflationary periods and growth stocks perform better in low inflation periods. When inflation is an upswing, income oriented or high dividend stocks generally decline. Overall, stocks do seem to be more volatile during high inflationary periods. So that's really the key line there. We're not really cared about the value and growth stocks and what that does. It's more to do with the volatility and the effect on the market. So what does that mean? Why is that important? Here we have the current US inflation rates from 2000 to 2021. And as you can see here, the annual inflation rate for the US is 5.4% for the last 12 months ended in July. And we will be checking this again. This data was published yesterday, so hopefully this is still new to some of you. And the next one we'll be releasing is in September 14th. So make sure to come back then to see what the inflation is. So why is this important? Well, we discussed this when these numbers were released for June, and we said this was the first 3-month period of over 4 that there's been in the last 20 years, and now we're at 5.4, which is the highest it's been in a very long time. And when is that time? Oh, funnily enough, it's 2008. So 2008 is the last period where we've seen 3 consecutive months of over 5% inflation. We've got here 5.4, 5.4, and we also had 5.4, 5.6, 5.4. So we had the trifecta, we'll call it there. So does this mean that the crash is coming right now? The crash happened at a similar time? Not necessarily, because the inflation was very high for the entire year. It was no lower than 3.9. So the lowest we've been is, well, we've already had 4 months of this high inflation. And then also the back end of 2007 was also quite high as well. So yes, this is a 3-month period with over 5%, which a lot of people have been saying, but 2008 on a whole had very high inflation. So if this continues for the next, well, few months, then we could be definitely seeing the same steps as '08. So why is this important? Here we have the CPI year-to-year growth, the CPIU, which is the Consumer Price Index, as I mentioned before. And here we have 2 charts, but I'm going to bring the attention to the second one. This is from shadowgovernmentstatistics.com, and this is some inflation charts. And you can see here, this is the inflation over time, the Consumer Price Index in red, and the SGS alternate in blue. And where are we right now? We are here, and where, if you were to look at this, does it look pretty darn similar? This line here, and what is this? Well, between 2006 and 2011, what would you say that was? That was the 2008 market crash, which would have caused this massive drop, and we are actually almost as high, if not higher, than that point in 2008. So why is that an important thing for the MOAS? Well, market crash can cause hedge funds to start selling assets, start being margin called, and then they run out of liquidity, run out of assets, and then that will in turn do the MOAS. If there is a big market crash, this could definitely help speed up the MOAS and possibly send things into the absolute stratosphere. So a lot of information to show that the markets are very unstable at the minute, despite the current record highs that we are always at. Just touching on some GameStop news elsewhere, you can see that this is the MSCI Equities Index, and GameStop has been added into the US Midcap 450. There's GameStop there. This will be as of the back end of August, and also our friends at AMC will also be added. So expect some negative moves when they get added into that, as whenever there's some good news for GameStop, there is always a short attack. You would not think that good news would lead to a stock price going down, but it does with GameStop very, very consistently. And the last thing, we'll just go to the top buys and sells on Fidelity. GameStop is a bit lower now. The overall volume of GameStop has been low. I think they got to about 1 million, which is the lowest it's been in quite a long time. So you can see it's inside the top 17. I believe it was 20 the other day, last time I brought you this. Very good buy to sell ratio, 3,000 to just under 800. And if we compare that to something like, well, there's not really that much we can compare it to that has such positive movement. This stock down here, AMC, is doing pretty well on the positive. So yeah, so as I said before, 3,000 to 800 in terms of that. Yeah, so that's it on GameStop. I think inflation can be a key factor here in the Moaz. In fact, let's just for giggles, let's bring up the old S&P 500, because who doesn't like looking at that and seeing where we are? So S&P 500, and we'll overlay GameStop over the top of it. Well, let's go all. Yeah, so you can see here 2007 October, and that was when the crash started to happen, and we hit the bottom in February 09. So if we just go back to here, October in 08, we were at 4.9. So that was the month after the 3-month growth. And then the bottom was in 09 when we had negative inflation. So really, these are pretty close times to from what we're seeing here. Now, yes, as I said before, the inflation for the entire year on 2008 was a lot higher than 2021, but it was at the bottom in October, which was after this month. So we could be seeing it this year, which is hopefully good news for everybody in terms of the market crash. Well, not good news for everybody, good news for apes, because this can help them as, but we shouldn't be too happy that there is a market crash. Right, guys, just want to say thank you for watching. Please give a like on the video if you've enjoyed it. Comment down below if on your thoughts on this, and subscribe if you're not already, because we're bringing out videos all the time, and I would not want you to miss one if you're interested in my content. So once again, thank you for watching, and I'll catch you guys next time.